And this week's question comes from Howard. He wants to know, which is the best long-term investment, an S&P 500 index fund or a total market index fund? First off, Robert, what's the difference?
Well, the S&P 500 index fund basically just buys whatever is in the S&P 500. So it owns 500 stocks. However, there are thousands of publicly traded stocks in the United States. So a total market index fund is going to try to buy many more beyond. It'll have that S&P 500, but another several. In fact, if you look at the holdings of the Vanguard's total stock market index, it holds almost 4,000 stocks.
Wow.
Right.
That's a lot. Okay. So then, what's the best long-term investment?
Well, historically speaking, if I had to choose one and hold on for the long term, it would be the total market index fund. That's because the S&P 500 is mostly larger companies. The total stock market index fund will also have some of what would be called mid caps and smaller companies that historically have outperformed larger companies. So according to Ibbotson from 1926 to 2014, small stocks have returned about 12% a year, large stocks about 10%. So 2 percentage points. But now compound that over that almost 90-year period or so. Large stocks, $1 grew to $5,300. $1 in small cap stocks. You want to take a guess?
$1 bajillion.
Not quite. 27,000.
Oh, okay.
So earning that extra 2 percentage points is a difference between 5,300 and 27,400. That's good. For those of you who have a century of a long-term time horizon. So having more small stocks is good, but that performance doesn't happen all the time. It can be pretty streaky, go through streaks, and it can sometimes last a long time. So in fact, over the last several years, the S&P 500 has actually done better than the total stock market index fund because large caps have beat small caps. So it's not a guarantee that you'll always do better in a total market index fund, but over the long term, you'll probably do better. The other question that Howard asked
Bonus question. What alternatives would you recommend to both or either of Vanguard's S&P 500 index fund and total market index funds, i.e. the same sort of funds from different investment houses, family brokerages like from Fidelity or Schwab?
Right. So when you're looking at just a plain vanilla S&P 500 index fund or total market index fund, most of the big financial services providers have their own version. That said, Vanguard's is generally the cheapest. And you have what's the traditional open-end mutual fund, and you have exchange-traded funds or ETFs. In all cases, Vanguard's is the cheapest. Does that mean if you're already with Fidelity, you should switch to Vanguard? No. In fact, Fidelity's S&P 500 index fund has the same expense ratio as Vanguard's. It has performed ever so slightly behind because of various ways that they do things, but it is not worth jumping to Vanguard for. So if you're with Schwab, if you're with Vanguard, T. Rowe Price, chances are whatever index funds they have are going to be fine. If you're starting from scratch and you want to be an index fund investor, go with Vanguard.
But if I have a brokerage account with Fidelity, can I already invest in Vanguard funds?
Yes, and I'm glad you brought up that point.
That's why I'm the interviewer.
You're the interviewer. Okay, so we're going back to this. So the index fund, the actual mutual fund, you will probably have to pay what's called a transaction fee to buy the Vanguard fund. And it can be anywhere from $25, $50, $75. But if you have a real brokerage account, you can buy the Vanguard ETF and just pay a regular commission, which is probably like $10 or something like that, right? Now, if you're with Vanguard and you buy Vanguard ETFs, they're generally commission free. But still, paying $10 for a good long-term investment, perfectly fine thing to do.
Sounds like no matter what Howard does, it's going to be okay.